Equity mutual funds is the most popular category of mutual funds among the individual investors. And the reason is that it allows the individual investors to participate in equities as an asset class without being an expert in it. And they do that by leveraging the skills of the fund manager in return for a fee that they pay to the fund manager. Now, what happens if the fund manager is not able to deliver the kind of returns that you expect when you invest in a mutual fund? It is very similar to you taking the bus ride from Mumbai to Pune, and midway either the bus breakdowns or the driver is not skilled enough to help you reach the destination. You choose a fund manager to do the stock picking on your behalf, and if he does a bad job, it is a double loss for you, because not only have you not made money in the equity markets, you also landed up paying a fee to the fund manager. Because of this was born the new category of funds which are known as index mutual funds. What exactly is an index mutual fund? An index mutual fund is very similar to a mutual fund where the money is invested in a particular asset class. For example, let's take up equities. But instead of the fund manager deciding what stocks to pick, an index mutual fund decides to replicate the index that mutual fund is tracking. So when you put your money in an index mutual fund, the index mutual fund is going to take that money and go and invest it in all the stocks that form a part of the index that this particular mutual fund is tracking. To quickly recap, the two most popular indexes in India are the BSE Sensex and the Nifty 50. While the BSE Sensex consists of 30 companies, the Nifty 50 index consists of 50 companies that form the Nifty 50 index. These two indices rightly reflect the market mood and are the most popularly tracked indexes in terms of seeing how well the market is performing. So when you invest in an index mutual fund which tracks the index, all you're doing is you're investing your money in all the stocks that form a part of the index. So if I take an example of a Nifty 50 index, if you were to earn returns which are exactly the same as the returns of a Nifty 50 index, what you will have to do is you'll have to go and buy each and every stock individually, and that requires you to buy 50 stocks, and that is not an easy thing to do if you were to invest directly from your demat account. A simpler way is to put your money in an index fund which will in turn track the particular index and buy all the stocks of that index for you. This form of investing is also known as passive investing. Passive because I am purely trying to replicate the returns of a particular index without trying to use my skills or without trying to use the skills of the fund manager to try and make extra returns. So an index fund is a mutual fund minus the fund manager's active management skills. That means I do not need the expertise of a fund manager to pick and choose which stocks the fund must hold, because that is decided by the constitution of the index. So whatever 50 stocks form a part of the Nifty 50, those are the stocks which the fund manager will buy and hold in the index fund. The benefit of this is that you can get the returns of an index without having to individually buy all the stocks which form a part of the index, and because you do not need the active fund management skills of the fund manager, the cost that you pay for holding an index fund is lower than the cost that you pay for holding a regular diversified equity fund. Since index funds are similar to other equity mutual funds, they have the same drawback of other equity mutual funds that you can buy them only once in a day. At the end of the day, the NAV of the fund is declared, that is the net asset value or the value at which you can make a trade, and that is the only time that you can buy or sell a index fund. To overcome this drawback, a new category of fund was created which is known as the exchange traded fund, or popularly known as the ETF. An ETF is very similar to an index fund in terms of the fact that it also invests all its money in the underlying index that it is trying to track. So if an ETF is tracking Nifty 50, it will invest all the money in all the shares that form a part of the Nifty 50 index. But what is different with an ETF is that it is listed on the stock exchange, and just like an equity share, you can buy and sell an ETF multiple times during the day. Once an exchange traded fund is created based on the pool of money it has been able to collect, the units of the ETF are listed on the stock exchange, and you as an investor can buy the units of an ETF multiple times during the day, just like you buy an equity stock. So the major difference between an ETF and an index fund is that you can buy and sell an index fund only once in the day based on the net asset value of the index fund, which is declared at the end of the day. Whereas in case of an ETF, you can track the market on a real-time basis and decide to buy the ETF, which in turn is nothing but reflecting the value of the index, and you can buy and sell the ETF multiple times during the day. An index fund or an ETF allows you to purchase the entire basket of stocks that form a part of the index that they are tracking with a single transaction, wherein you just have to buy the index fund or the ETF. If you compare a mutual fund with an index fund and with an ETF, with respect to its fees, a mutual fund is always going to have the highest fee because there the fund manager is actively managing your fund, picking stocks which he thinks are going to make you money, and that is why you pay the maximum fee for a mutual fund. An index fund, the fees are lower compared to a mutual fund because there is no active management required here, and all you're doing is replicating the index that is being tracked. Similarly, for an ETF also, the fees is much lower than the fees that you pay for an active fund, because here all the fund manager is doing is replicating the index without any active management skills. With respect to asset classes, you have mutual funds that invest in all asset classes. Similarly, you have index funds that track all the asset classes, and even ETFs today are available for taking an exposure to all the asset classes. The key differentiation being a mutual fund and an index fund can be traded only at the end of the day based on the NAV of the underlying asset, whereas an ETF can be traded multiple times during the day by placing a trade on the stock exchange. And how do you place a trade on the stock exchange? It is exactly like placing an order for an equity stock, wherein you allocate funds from your bank account to your trading account, and through your trading account you place an order to buy the ETF on the stock exchange. Once the order is confirmed, the number of units that you placed an order for are credited to your demat account, and the money is allocated to the exchange, which in turn passes it on to the seller of the ETF units. Now, given that an ETF tracks the index, how do you choose which ETF you must buy? Because if there are 5 different companies holding an ETF which is going to track, say, the Nifty 50 index, all 5 of them are going to be doing exactly the same thing. They are going to be investing their money in those stocks that form a part of the Nifty 50 index. So how do you differentiate which company's ETF is better compared to some other ETF? 3 factors that should help you decide that is, first is the low tracking error. By tracking error, we mean the difference between the returns made by the ETF versus the return made by the index. Since the index keeps changing on a regular basis, it is the ETF's job to constantly sell those stocks which exit the index and buy those stocks which become a part of the index. And the more closely the ETF is able to do it, the lesser would be the tracking error. So the lower the tracking error, lesser is the mismatch between the returns of the ETF and the index. Secondly, you must pick that ETF which has a high trading volume, so that takes away the liquidity risk that you buy a ETF and when you want to sell it in the market, you don't have a buyer on the other side, right? To take away that risk, you always prefer that ETF which has the highest volume in terms of the number of trades which are happening on the exchange. The third factor that would help you decide which ETF to pick is the expense ratio. Since all the ETFs are doing exactly the same thing, that is replicating the returns of the underlying index, the one which is having the lowest expense ratio will give you returns which are closest to the returns of the underlying index. If you look at the recent trends of active versus passive investing, what has happened in most of the developed countries is the pool of money which is getting into passive investing is growing at a much faster pace, and today is much larger compared to the pool of money that is going into actively managed funds. The reason is because today the actively managed funds have not been able to justify the fees that is paid to them in terms of the returns that they deliver for the fees that they charge to the investors. Because of this mismatch, most investors today prefer to put their money in passive funds. If you look at the trend in India, actively managed funds continue to do pretty well, and although the demand for passive funds is growing, if you look at the total amount of money that is allocated towards an active versus a passive fund, the pool of money which is in active funds, that is actively managed equity mutual funds, is much more than the money that is today invested in an index or an ETF. Having said that, you can see the trend change even in India, with more and more money being allocated towards passive funds like an index fund or an ETF. Whether you must pick an ETF or not is a function of what you expect from your investment. If you want to earn returns which are equal to the returns which the market is giving you, which is measured by the returns of an index like a Nifty 50, then you would want to pick an index fund or a ETF. The reason being that an index fund or an ETF comes with a low expense ratio, which allows you to mimic the returns which the market is able to generate with the minimum cost possible. To give you an example of the expense ratio of these funds, if you pick up an ICICI Prudential Blue Chip Fund, the direct plan of this particular fund has an expense ratio of 1.14% per annum, versus an ICICI Prudential Nifty Index Fund, which has no active management, which just replicates the Nifty Index, has an expense ratio of just 0.10%. That is almost 10 times lesser than the expense ratio of an actively managed fund. Versus if you pick an ICICI Prudential Nifty ETF, it comes with an expense ratio of 0.05%. So you can see that because of the high expense ratio associated with an actively managed funds, it should justify it with returns which are much higher than the returns which the market is able to give you. And that is the reason why active funds are slowly going out of favor in the developed countries, because they are not able to justify the higher expense ratios that come with these active funds by generating returns which are higher than what the market is able to give them, or higher than what you're able to achieve by just investing in a low cost product like a ETF. Although we've taken an example of only equity all through, ETFs today invest in all other asset classes also. So you have an equity ETF, you have debt ETFs, and you have gold ETFs as well. An equity ETF can track any of the equity indexes, whether it be a large cap index or a mid cap index. You can also have an ETF which is tracking just the pharma sector, as long as there is a pharma index for the markets to track. So it is not necessary that an ETF will be made only for the Nifty 50 or the BSE Sensex. An ETF can also be investing in small and mid cap stocks if that particular ETF is tracking a small cap index or a mid cap index. In India today, you have debt ETF in the form of the CPSE ETF, which invests all the money in issues only by the government public sector undertakings. Gold ETFs is a very popular way to hold gold because it is an extremely low cost product compared to buying physical gold, or even compared to buying gold via the mutual fund route. While index funds and ETFs come with a low expense ratio, what you must clearly know is that under no scenario can these funds beat the market returns. While the very objective of the fund is to track the market returns and give you returns as close as possible to what the market is giving you. After deducting for their expenses, you will land up with a return which is slightly lesser than the market return. To sum up this session for you, index funds and ETFs are a low cost way for you to track and earn the returns which the market is able to give you. While an ETF can be traded like a stock multiple times during a day, an index mutual fund is similar to a mutual fund and can be traded only once. And the fact that they are a passively managed fund, it is a popular way today of replicating the returns of the market at a low cost. With this, we'll wrap up our discussion on index funds and ETFs and move back to our next asset class, that is gold, and learn on how you can invest in gold via the mutual fund route.